Part 1. Introduction. We often refer to sports as an unscripted drama. We are captivated by the sweat and tears of the players on the court and the compelling narratives of victory and defeat. However, if we shift the focus of our lens from the arena to the owner's box and the flow of capital behind it, we find a meticulously calculated, scripted drama unfolding. The recent movements of capital within the NBA market are not merely investments. This represents a legitimacy battle between two factions that have branched out from a massive root in the American financial world, KKR, in an attempt to structure a sports league into a financial product. We define this phenomenon as the KKR Civil War. The public generally consumes headlines simply stating that private equity investment has been permitted in the NBA. In reality, the NBA was the first among the four major U.S. sports leagues to boldly unlock its gates to private equity in 2020. Thanks to this, a significant number of deals have currently been concluded in the form of institutional investors. However, if you look beneath the surface of these numerous deals, you will discover that the market is surprisingly being bisected by just two players. They are Arctos Partners and Blue Owl Home Court. Blue Owl is aggressively expanding its portfolio, including the Phoenix Suns, Sacramento Kings, Atlanta Hawks, Charlotte Hornets, and Minnesota Timberwolves. Conversely, Arctos has preemptively secured teams with high valuations or those aiming for complex entertainment structures, such as the Golden State Warriors, Utah Jazz, and Philadelphia 76ers. Interestingly, the competitive landscape between these two firms begins from a single root, KKR. It is a confrontation between Blue Owl, established by KKR veterans who seized the market first, and Arctos, which represents a proxy war fueled by massive capital from KKR itself, rather than direct participation. This is the core of the structure we will uncover today. To understand the context of this complex capital war, Structure Syndicate has organized its opinion into the following three parts. Part 2. The mechanics. Capital as a key. To understand this massive power game we have named the KKR Civil War, we must first grasp the terrain of the battlefield, the rules of engagement. Why did the NBA unlock its high-profile gates, and by what mechanism did it draw these private equity firms into the league? 1. The valuation paradox. No buyers left. NBA team values have skyrocketed geometrically over the past decade. The enterprise value of the Golden State Warriors has exceeded approximately $7 billion. Here, a serious liquidity trap emerges. In the past, regional tycoons bought and sold teams with their personal assets. However, as team values climbed into the trillions, the pool of super-rich individuals capable of mobilizing this level of cash personally has dried up. A structural crisis arrived where owners wanted to sell, but there were no buyers. Essentially, the exit window was blocked. Consequently, in the 2020 to 2021 season, the NBA Secretariat made the decision to allow private equity participation, the first and most bold move among the four major U.S. sports. This was not simple deregulation, it was an essential capital transfusion mechanism for the league's survival. 2. The 30-20 rule, a meticulously calculated firewall. However, the NBA had no intention of selling its soul to capital. They designed a highly sophisticated double-lock mechanism to protect the management rights of existing owners. This is the 30-20 rule. Rule 1, league level. The total amount of equity a single team can sell to private equity is capped at a maximum of 30%. This completely blocks any change in ownership or threat to management control, no matter how desperate the need for money. Private equity must remain strictly as financial investors. Rule 2, fund level. A single private equity firm cannot hold more than a maximum of 20% equity in any one team. This is to prevent a specific fund from having an excessive voice within the team. Thanks to these regulations, NBA owners could secure cash without threats to their management control, and PE firms gained the opportunity to get a foothold in high-scarcity assets like the NBA. This is the background behind why so many deals in the current market have been concluded in the form of institutional investors. 3. The rise of holding company investment, teams as derivatives. Another structural feature we must note here is the generalization of holding company investments. Private equity firms do not prefer simply buying stakes in basketball teams. They want risk hedging. Thus, the method of investing in the parent company that owns the team emerged. 1. HBSE, Arctos Partners, instead of investing directly in the Philadelphia 76ers, acquired a stake in its parent company, HBSE. Since HBSE owns not only the NBA team, but also the NHL's New Jersey Devils. From Arctos' perspective, they completed a package deal diversifying into basketball and hockey with a single investment. 2. SEG. Similarly, for the Utah Jazz, Arctos chose to invest in SEG, led by Ryan Smith. SEG owns the Utah Jazz, the MLS team Real Salt Lake, and recently the NHL's Utah Hockey Club. This structure provides investors with portfolio diversification and offers owners the justification of enhancing the valuation of the entire group. 4. The battlefield set for civil war. The entities that perfectly met these demanding conditions were none other than the giants of the private equity industry. And at the center stood Blue Owl, created by KKR alumni in Arctos, directly selected by KKR. Now that you understand the regulations in the board, how did these two giants actually move upon this board? In the next part, we will compare and analyze their actual portfolios and deal structures. Part 3, the precedents, two towers, divergent strategies. Previously, we confirmed the rules of the game designed by the NBA, the 30-20 rule and holding company investments. Now we will compare and analyze how the two giants who have bisected the market based on these rules, Arctos Partners and Blue Owl Home Court, have actually expanded their territories. The interesting point is that although both houses emerged from the same root, KKR, their tastes in shopping for teams and their methods of structuring deals are completely divergent. 1. Arctos Partners. Overwhelming valuation and platform strategy. Arctos' strategy is clear. Pick only the most expensive and the largest assets. They chose the path of becoming the second largest shareholder of a massive sports entertainment empire, going beyond simply buying equity in basketball teams. The Warriors case. Arctos pinpointed and targeted the Golden State Warriors, the most expensive team in the NBA. The Warriors' enterprise value exceeds approximately $7 billion. Arctos has been accumulating shares since 2021 and currently holds about 13%. Although this is a minority stake, it is a mega deal where the invested principal alone amounts to nearly $1 billion. When others shook their heads saying it was too expensive, they bet on the premium of the number one asset. The platform strategy, as mentioned in the Philadelphia 76ers and Utah Jazz cases, Arctos targets the parent company, not the team itself. This creates the effect of including other sports like the NHL in their portfolio all at once. The Grand Slam. Arctos' ambition does not stop at the NBA. Recently, in December 2024, as soon as the NFL unlocked its gates to private equity, Arctos received approval to acquire a stake in the Buffalo Bills, achieving a grand slam by planting its flag in all 4 major U.S. sports leagues. This implies that Arctos has gone beyond a simple financial investor to become a hegemon of sports assets, encompassing all disciplines. 2. Blue Owl, the omnipresent incumbent. On the other hand, Blue Owl's strategy places its emphasis on dominance as an NBA specialist. While Arctos broadly expands its disciplines, Blue Owl has drilled vertically into the single market of the NBA. Aggressive expansion. Looking at Blue Owl's portfolio, it is spread across the entire NBA map, including the Phoenix Suns, Atlanta Hawks, Charlotte Hornets, Minnesota Timberwolves, and Sacramento Kings. They are aggressive enough that whenever rumors circulate that an NBA team stake is on the market, Blue Owl's name is mentioned 9 times out of 10. Continuity strategy. The biggest feature of Blue Owl's investment is majority shareholder risk hedging. 01. Phoenix Suns. They entered during the Robert Sarver era, but even during the sale process, when the owner changed to Matt Ishbia, they did not sell their stake and remained as a major shareholder. 02. Charlotte Hornets. They acquired a stake in 2022 when basketball emperor Michael Jordan was the majority shareholder. Even after Jordan sold the team and left, Blue Owl's capital remains in the team. This is an important precedent showing that private equity functions as an underlying asset of the team, regardless of changes in ownership. 3. The convergence. Encounter in Sacramento. There is a place where these two giants walking different paths met head-on. It is the Sacramento Kings. Uniquely, the Kings received investment from both major sports PEs, Arctos, and Blue Owl. The deal was concluded, recognizing an enterprise value of approximately $1.8 billion in 2021, which has significant implications. It is a situation where Blue Owl, representing KKR's DNA, and Arctos, acting as KKR's proxy, cohabit within a single team. This is a symbolic event showing that NBA teams have evolved past the stage of relying on a specific fund for capital raising, to a stage where they compete or mix multiple institutional investors to structure the optimal capital structure. To summarize, Arctos is maximizing valuation through the compounding of premium assets, while Blue Owl is pursuing a strategy of enjoying the growth of the NBA sector itself by expanding its market share within the league. So why are they so obsessively committed to sports? Is it simply to make a profit by selling tickets and uniforms? No, their real purpose lies elsewhere. In the next part, we will uncover their hidden incentives. Part 4. The incentives. The KKR Civil War. What are they targeting? Why have the smartest monies on Wall Street joined the sweat-soaked war of the locker room? The answer to this question converges on 3 letters: KKR. This massive capital war is not simple sports investment. It is a KKR civil war that inevitably occurred during the evolution of the private equity industry, and a result forged by the survival instinct of capital-seeking new revenue streams. 1. The origin. KKR's DNA versus KKR's capital. 1. Blue Owl. Blue Owl, currently securing the most teams in the NBA and operating prolifically, was originally more famous by the name Dyal Capital. They are a major player in the GP stakes business, which buys stakes in private equity managers. This house, established through a merger by a veteran figure who cut his teeth at KKR, views NBA teams as essentially another private equity firm. In other words, they interpreted them as stable assets where cash flows from broadcasting rights and sponsorships come in regularly, regardless of wins or losses. Inheriting KKR's aggressive DNA, they encroached upon the NBA ecosystem faster than anyone else. 2. Arctos Partners. On the other hand, the parent company, KKR, fell into a dilemma. Jumping in directly as a player presented complex regulatory barriers and conflicts of interest, yet staying put meant watching the collateral branch, Blue Owl, monopolize the market. Here, KKR chose the typical Empire's method. Instead of fighting directly, they invested equity in Arctos Partners, which had emerged as the market leader, putting them forward as proxies. Ultimately, the current NBA investment landscape is a proxy war between Blue Owl, which became independent with KKR's DNA, and Arctos, which is backed by KKR's massive capital. This is the real structure hidden beneath the surface of the deals we are witnessing. 2. The asset class. Discovery of uncorrelated assets. The reason they fight so fiercely is due to the unique financial characteristics held by sports teams. Whether a financial crisis hits or interest rates rise, people still watch basketball. 1. Scarcity. There are exactly 30 NBA teams in the entire world. They cannot be printed like money. This possesses a scarcity more powerful than Bitcoin or apartments in Gangnam. This is why the Warriors' value exceeds $7 billion. 2. Sticky valuation. Even if the stock market crashes, team values do not easily fall. From a private equity perspective, it is the ultimate safety net that lowers portfolio volatility. The fact that Blue Owl firmly maintained its stake amidst the chaos of the Phoenix Suns' ownership change and did not withdraw funds after Michael Jordan left the Charlotte Hornets is due to their conviction in the downside rigidity of this asset. 3. The next battlefield. The final weapon, NFL. This civil war does not end in the NBA. The battlefield has already begun to shift. It is the most expensive sports league on earth, the NFL. In December 2024, the NFL finally unlocked its gates to private equity, And the one who seized the first victory on this new battlefield was KKR's proxy, Arctos. Arctos dominated the initiative by receiving approval for the NFL's official deal number one, the acquisition of a 10% stake in the Buffalo Bills. Not stopping there, they put their name on the Miami Dolphins deal alongside Ares Management, achieving the so-called Grand Slam by conquering the NBA, MLB, NHL, and finally the NFL. However, Blue Owl, the possessor of KKR's DNA and the most aggressive predator, will certainly not just watch from the sidelines. It is certain that Blue Owl will soon jump into NFL team acquisitions based on the track record and funding power accumulated in the NBA. 4. Strategic outlook. Who will be the ultimate winner? Going forward, this market will become a battle between platformization like Arctos and specialization like Blue Owl. Regardless of who wins this war, one thing is clear. Sports is no longer a realm of romance. It has become a meticulously calculated financial product and a venue for money games where massive capital collides. Part 5. The Syndicate's Note. So far, we have covered the cold-blooded siege warfare of private equity firms taking place behind the flashy courts of the NBA. The public cheers for LeBron James's dunks and goes wild for Stephen Curry's three-pointers. But we have seen where the numbers generated by that excitement flow. The enterprise value of the Warriors reaching $9 trillion and the sophisticated valve called the 30-20 rule designed to accept that massive liquidity were the starting points. The competition between Arctos and Blue Owl unfolding on this massive board is not a simple fight for market share. It is a proof of who inherits KKR's legacy and a signal flare announcing that sports teams have transformed from the exclusive property of regional tycoons into highly structured financial assets managed by Wall Street's portfolio theory. In short, Arctos intends to become a platform encompassing all disciplines through its Grand Slam, while Blue Owl intends to become the base infrastructure by rooting itself deeply within NBA teams. In this new league governed by capital rather than players, in valuation rather than victory or defeat, we will conclude by taking a moment to think about what position you can take